Okay, so hopefully you should now be starting to get quite familiar with the supply and demand concepts that we have looked at so far. So let's do a quick, 2-minute crash course on supply and demand, right? So typically with demand, we have kind of two ways that we look for it. We either have a range created demand where price is stuck within a range. We then see that rapid breakout to the upside as price initiates to the upside, and we can clearly see that somewhere within that range demand then stepped into the market. Or we have pivot created demand where we essentially see a sharp sell before the buy as price then rapidly expands to the upside. In both cases creating demand, where of course we can either draw the zones from there, and we would look for price to either return to those zones to then look for buys to catch that next bullish leg, and so on with the pivot created demand there. However, if you were to draw on, all of those demand zones within the market, they're pretty much going to be everywhere because, as we know, price is constantly causing imbalances between supply and demand. Otherwise, the market would never really move anywhere, right? It would just stay in a range pretty much for eternity. So, what was the main thing that we've looked at so far to essentially validate where we're going to see those strong demand zones? Well, the main thing that we've looked at is those structural zones, right? So we want to see where demand stepped in to cause a break of structure. So in terms of continuation, let's say we're in a bullish market and price is creating a series of higher highs, higher lows, and then higher highs, right? So it caused a break of structure. We're trying to then identify where did that demand step in around here that led to the bullish move to cause that higher high, to cause that break of structure. Right, so we'd look for a zone somewhere within here, and then that then validates that this area of demand, whether it's range created, pivot created, a single candle, a fractal refinement, whatever, we're just trying to use that break of structure to increase the probability that this is a strong zone, so that when price returns, it will hold and it will give us a sustained leg for us to try and buy and ride that next bullish leg to the upside, right? And then the same for a reversal. So if price was making lower lows and lower highs in a bearish market, but then suddenly price makes a higher high, right? So we get that break of structure to the upside. We take out that lower high to form a higher high. We then look for where did that demand step into the market. That then helps us validate that this potentially is a strong zone because it caused a break of structure. It takes a lot of money to do that, right? So then when price returns to that area of demand, we can then hope that that zone will hold for us to capitalize on that next bullish leg. And then very quickly, we have the same for supply, right? So price would be in a range. It would then initiate out of that range to the downside. That would then give us our range created supply, where we would then look for price to pull back and potentially make another bearish leg, or we would have the buy before the sell, right? Pivot created supply. And then again, we would hope that when price returns to it, it will continue, but we don't just want to trade any old supply zone that we see in the market. We want to look for ones that cause breaks of structure. So for a continuation, that would be in a bearish market where price is making lower lows and lower highs and a lower low. So it obviously caused a break of structure to form that lower low. So then we want to look at where did that supply step in the market, right, to form that lower high. And then that's where we can look for price to then potentially continue that bearish leg. And then again, if a reversal, if we're in a bullish market with price creating higher highs and higher lows, and then price then formed a lower low, right, causing that break of structure to the downside, causing that first initial change of character, we would then try and anticipate where that supply stepped in the market and then look to sell from this area here, right? Because those areas of supply cause a break of structure, and the same for demand. So that's kind of the first out of two ways, right, that we've really looked to try and validate where those strong zones are in the market, right? All else things being equal, we're trying to identify those areas of supply and demand that led to a break of structure. So as you guys probably know from the title of this video and from what we've already mentioned in some of the earlier theory videos, the second main way we look at is what is called a flip zone. So let's just slowly go through this now. So this first example here of the supply and obviously the demand, this is pretty much just what we've gone through. So this is our standard sort of structural zone scenario that we look at. So in the first case with supply, what do we have? We have price moving to the upside, right, in a bullish market with a higher high, pulls back to form a higher low, and then makes a higher high. But then what happens? Price falls down to make a lower low, so we get that change of character, right? We get that break of structure to the downside. The change of character is just the first time we see that lower low, right, after a bullish market. And then essentially that creates an area of supply where we wait for price to pull back in, and then anywhere within that supply zone, we can look to get short with our stop somewhere above the high to try and capitalize on that next bearish leg. So this red box obviously represents the supply zone. Now I've just drawn it on the most unrefined way, so just taking the entire range, taking the entire right? The buy, just drawing the supply on that range, right? The entire buy before the sell that leads to that change of character. So that's the most unrefined way. But of course, we could look or trying to identify to the pivot, right? Or potentially even a single candle, or potentially even, refine it to a fractal wick or so on and so forth, right? It doesn't matter so much now. I just want you to understand why I've drawn the box that way. But this is just kind of that standard structural zone entry model that we've been looking at, right? Where does that supply lead to that break of structure? Whether it's a continuation or in this case, that first initial change of character, then we can look to sell from the supply that led to that break of structure. And then the exact same thing for demand, right? We're just looking for where did demand step in to cause that break of structure to the upside. And in this case, I've just drawn it on the entire range, right? The last sell before the buy, and then we look to buy anywhere within that range. But of course, we can then refine that zone if I can get my mouse to grab it for me. I have to play around with that, right? To either down to the pivot, one candle, fractal refinement, so on and so forth, right? We know the more refined we get, the more we can increase our risk to reward, right? Because we can enter in lower, but potentially we may get missed, right? So that's essentially just our standard entry model that we've looked at so far. Now, the next thing that we can start to introduce is obviously flip zones to increase the probability or just another way, right, of validating what may potentially be a strong zone. So in this case, in its most simplest form, all we are looking at is where supply and demand are interacting, where they essentially meet, they have a bit of a battle, and then one of them essentially overpowers the other one and takes control. So we're not just, before we've only been looking at, what causes the break of structure, but now we're looking at where does supply end up taking out demand and where does demand end up taking out supply. So again, just to make that clear, before we've purely just been looking at what causes breaks of structure, right? We've just been looking at what leads to breaks of market structure, but now we're looking at what leads to taking out demand. Where is the supply that took out demand and where is the demand that took out supply? Okay, so let's look at this first case. So in this case, right, price is making higher high, higher lows, higher high, right? So obviously for price to make that higher high, what did it do? It caused a break of structure of this high. So somewhere within this leg, demand stepped in to cause that higher high. So that's what's denoted by this red box. We have some demand. So at this point, right, in the market, obviously we can't see anything else, just have to imagine that's not there. But as price is pulling back into our demand zone, all else things considered, what would we expect? Well, we would expect the continuation of that bullish order flow, right? We would expect this demand zone here to continue price upwards to make a higher high, right? It needs to break this high here, get that break of structure and make a higher high. Because that is what this demand zone's job is. Its simple job is for price to create a higher high, to fulfill those buy orders and then overpower supply to make a higher high. But we will often see in the market is price will come in, it will fill those buy orders, it will then attempt to make a higher high, right? So it will have a reaction, but it will fail to make a higher high. So it will fail to break this high here. And then what will happen is price will then come down. It will take out where that reaction formed, the start of the reaction. So that is what FR stands for, a failed reaction. Right, so as soon as price goes below that dotted line, right, as soon as that happens, the reaction has now failed, which means demand has failed to do its job. Right, so the minute we are below that dotted line, literally the very micro pip that price moves below where that initial reaction started, where demand kicked in to try to make the higher high, if it doesn't take out this high here and it fails to do its job and price starts to come back down, the minute we break below that reaction means we get a failed reaction, right? So that means that demand is now failing and then price moves down lower. We actually then take out the low. So this is where we get the change of character, which is essentially what we're looking over here. So now what do we have? We have demand failing, right? And we also have a market structural low being taken. So what that means is a lot of supply has stepped in somewhere to take out demand and to take out the structural low, right? So you can see here, all we looked at was the structural low going, whereas over here we have more confluence because we not only do we have structure being taken out, but we actually have that demand being taken out, okay? So then when price moves down and we had the failed reaction and we have the change of character, we have that structural low going, somewhere up here, supply stepped in. So where do we draw that supply zone? Just delete this in a minute, right? Basically anywhere within that buy, right, where the reaction started, that buy before the sell, that is our supply zone, okay? So the reason why I've drawn it with a bit, what looks like a bit of a weird box, you guys might not have seen that at this stage, it's just something that I use this tool here because essentially This box just represents supply, but it's a nice tool to use because it has a line in the equilibrium, right? That 50% level, the EQ. And what do we know? We haven't talked about entries in a lot of depth, but we can enter anywhere within the zone. But one of the things that we can do is we can always look to enter on the EQ just to increase our risk to reward, okay? So don't worry massively about this at the minute, right? I've spoken a little bit about it in a little bit of depth before. But you know, the main point for now I want you guys to just concentrate on is that we can enter anywhere within the zone, okay? So don't worry too much about how this box is drawn. We'll talk about this in a lot more detail, but essentially it's just using this fib tool here. I'll just show you where it's drawn actually now. Let's see which one it is that I use. I believe it would be one of the favorited ones, so it's not in here. Okay, so it's a parallel channel is the one that I'm using in this one on the left hand side. So in the trend lines, if you say parallel channel, and I'll just show you the settings on that. So the way you draw this is you would click at the base of the candle wherever you wanted to draw it, right? And then you would hold it across. So if you hold shift, it will draw a straight line, right? We want to have it nice and accurate, nice straight line. And then you click again. And then if you move it up to basically the height of the range that you want to draw it, and then boom, there you have your supply zone. But the reason why it's useful is just because it gives that nice equilibrium level if you want to enter in the middle of the zone. And if I just show you the settings for that, essentially that's how I've got it if you want to copy that template. But for now, like I said, all I want you to focus on is that this essentially just is another way of drawing a supply zone, okay? So yeah, and that's it. This is basically the highest probability way that we have of looking for supply and demand. And essentially, it's just a flip plus a chock. That's the most simple way I can describe it, okay? And all that means is that we have demand, and then it flips to supply because supply is now in control, and it also causes that change of character. So that's why it's called a flip and a chock. So here, all we have is a chock because we've just been looking at market structure being taken out, right? And then we look for what caused that change of character, what caused that break of the high or the low, and then we look for price to come back into it, right? But here, we do have the exact same thing. We have the chock, but before the chock, what happens? Well, we see that battle between supply and demand. And that's what key. The key thing that you need to see here is you need to see this reaction occur, because you need to see the battle occurring. If the battle doesn't occur, then we're not as interested, right? What we want to see is this happen, because what it means is that demand tried to hold and it tried to make the higher high, but the fact that that reaction then failed and came down, you have to think about what does that mean in reality? But what it means is that this supply must be really strong because this demand was significant, right? Because if price, like here, right, it just goes up and it just melts straight down, yes, it did take out a strong low, right? Because that low should hold and it should make a higher high. But if price is coming straight down, maybe actually there wasn't that much demand in this overall area. So when supply comes down here, maybe this means that this red supply zone actually isn't that strong. And then sometimes what can happen is price can come back in, you can get short, and it can keep going up. So remember, the whole point of this whole game we're playing is we're just trying to validate supply and demand zones to try and see which ones are strong and which ones are going to hold, right? So part of that is finding our supply zone and going, what did this supply zone achieve? Did this supply zone achieve anything significant? So in this case, with the standard entry we've been looking at in structural zones, instead of just drawing on any old supply zone, right, where price initiated out of a range or a pivot, what we look for is what are the ones that caused breaks of structure, right? Because that is something significant in the market. So we hope then that when price returns, it was a lot of supply that had to step in to take out that low. Therefore, this supply zone should hold and we should see that next leg down. This is the same concept. Instead of just taking out a structural low, it also had a battle with demand, where actually this demand, there was a lot of buy orders in here and it did try to do its job. It tried to take out this high and make a higher high. So then when supply steps in and overpowers it and it flips to supply that's in control, that's just another sort of tick in the box to try and tell us that actually it did take a lot of supply in the market to, eradicate all of these buy orders, to overpower demand here and cause that break of market structure, okay? So that's what you're always trying to ask yourself is, what did this supply zone achieve? Is it strong? Yes, it is, because it took out a strong level of demand. You can see that demand tried to hold and it took out a structural low. So that's like two ticks in the box, right? Compared to over here, where it was just kind of one tick in the box, right? If that makes sense. So yeah, let me try and keep this super simple again. So we have price making higher highs and higher lows. Price pulls back into demand. It tries to do its job. It tries to make a higher high. It fails to take out this high, so it fails to make a higher high. Then as soon as price comes down, at this point here, as soon as we move below that dotted line, below where the reaction initiated from, that means the reaction has now failed. It's failed to do its job. But then when price goes even further and it takes out the actual structural low and we get that change of character, We now have both of those those criteria ticked off the box, right? So then we can then mark out that buy to sell range. We can take the whole range like this. We can, just like any old supply zone, right? We can refine it to the last pivot. We could refine it to a single candle, right, within that pullback, or we could even do the fractal refinement, so on and so forth, right? The same rules always apply, but for the sake of the example, I'm just going to keep it to the whole range, right? Just to show you that you can get short anywhere within that range, right? It's all valid anywhere within that range, but the more refined you are, right, more risk reward, but more increased probability of missing the trade, okay? And that is how we look to get short. So that's essentially your flip and your chalk, looking for that battle between buyers and sellers, looking for the breaker structure, and then that's our area of supply that we can then look to get short from. And then the exact same thing with demand, right? In this case, it's a change of character, so price is making lower lows, lower high, and a lower low. So for price to cause that lower low, to break that structure there, right, we look for the supply that caused price to make that lower low. So then what is the blind expectation when price comes back to this supply zone? Well, we would expect price to pull back into it, and then for supply to do its job, it should make a lower low, right? It should cause this low to be taken out, it should cause a breaker structure, and it should cause a lower low if supply is to do its job. But in this case, it tries to do its job, but then somewhere within here, demand steps in to then cause the reaction to fail, right? As soon as we're above that dotted line where the reaction initiated from, right, this circle here, as soon as we're above it, now you know that the reaction failed, and then price continues to go up. So now we also have structure failing, right? The bearish structure is failing. So we now have bullish structure. We also have a failed reaction. So what that means is we now have a strong area of demand, because not only did it overpower supply, but it also caused structure to fail, and we got that higher high. So exact same thing again, right, as we looked up here, but the opposite. So then we can mark out this whole sell before the buy range as our area of demand, or of course we can refine it, to a pivot, to a single candle, or a fractal refinement, so on and so forth. And that's it really. So before, right, like I said again, we're just going to keep going over this and just hammering it in, right, until we really just drill this into our subconscious. But all we looked at before this lesson so far was essentially, your standard break of structure, right? In this case, obviously it's a reversal, but it works the same for a continuation. We're just looking for where does supply cause a lower low, right? It caused a break of structure. We look for price to come back in, and then we look to sell, because we hope that it was strong enough because it caused that break of structure. Same as demand, right? It took out a lower high to form a higher high. So that's one way of validating a strong level. Here we have the exact same. It does cause that change of character, but it also takes out demand. Now, how do we know, again, the thing that's really important about this, and it can be quite subtle in the live market, is you need to see the reaction for it to be a flip. Because if price just does this, right, it comes up, yes, it creates demand to make a higher high. But then if price just comes straight down, right, just pretty much in a straight line, like multiple candles that just come down, and you don't see any reaction, then that is not a flip. Because there is no, you need to see that battle, you need to see that reaction. And the reason why you want to see that reaction is what I was saying earlier, is because you want to know that actually this demand was somewhat significant, that there was strong buying pressure in here, that price did try to make a higher high, but then the supply stepped in to smash through, okay? And that is the subtle but key difference, right? So your flip plus your chalk, this really is kind of your A+ setup in terms of your execution entry, in terms of wanting to see not only the reaction failing, right, so seeing the supply to demand flip in this case, but also that it leads to that change of character, that it leads to a break of structure at the same time, right? Because that is essentially your structural zone and your flip zone combined together. So then when price comes back within here, that is a very high probability zone. Okay, now the final one we're going to look at is a bit more aggressive. All right, so this is your A+ setup. This is the best. This is a bit more aggressive because we only have the flip. So you can see here, this is only a flip. This is only a chalk, right? But this is obviously both of them. Okay, pretty simple stuff. So what's the subtle difference here? Because sometimes this can be a little bit tricky to see in the live market, the difference between them, but it's very, very similar. So we have price creating a higher high, pulls back to form a higher low, then we make a higher high. So obviously to cause that break of structure to the upside, to form that higher high, right, we must most likely have a demand zone that caused that higher high. So then when price comes back in, if demand is going to do its job, what should it do? It should form a higher high. It should take out this high. But if price goes up higher, you see the reaction happen. Remember, seeing the reaction is so key. You need to see price trying to make that higher high so that it validates that there is an area of demand here. So as price goes up higher, and then as soon as it comes down, and as soon as it's below that dotted line, right, below where the initial reaction essentially originated from, where that reaction initiated from, as soon as price comes below it, as long as price never took out that high, right, so it didn't do its job, The minute we are below that dotted line, you now know that the reaction has failed, okay? So what that means is, just like before, this whole area, this buy before the sell, once we go below that failed reaction, this whole area, denoted by the box, is your area of supply that took out demand, okay? So what you can see in the difference here is price doesn't cause a change of character yet, right? So it's still technically within the demand zone, right? If I draw the zone across, it's still within here, right? So there could be still some demand orders lower in the zone that now could be filled, and it could go up now, right? There could be, this is the risk of this setup, there could be some nice buy orders left within here, right? That wasn't initially tapped into from that first initial reaction, and this is the risk, because you could be looking to get short, but price could go up higher from here, okay? Because what? We don't have the change of character, we don't have that entire supply zone failing, right? Like we did over here, before price comes back in for you to short. So this is why this is riskier, because you only have the flip, you only have the failed reaction, you don't have the change of character to truly give you that extra confirmation that price has taken out the entire supply zone, and then we come back in and we go, okay? So hopefully it's a bit kind of, you can see why this is riskier, because you're trying to get short, and there's the potential that price could fill some orders within here and it could go up higher. Okay, so obviously again, this will come with testing what makes most sense to you, and just time in the market for whether you are happy to take just flips, or if you want to see a flip and a change of character, right? You want to see that break of structure as well. So, the obvious advice I can give you guys is, especially as you're starting out, only focus on the flip with the change of character. So stay away from just flips at the start, because they are much lower probability, they are a lot more aggressive, right? Because you're getting in where price could just go higher, it could fill up some orders within here and go. So you may take more losses. Now, as you get more experienced and you're good at picking higher time frame areas of value, and you're good at putting all of the confluence together, then you can get a bit more aggressive and potentially look at flips on their own if you want to, because sometimes what will happen is just this exact sample here where we'll get the failed reaction, price will come back in, you may go, okay, I don't want to get short from here, I want to wait for the change of character first, and then price can just go, right? And then it doesn't always come back up to this level, and you may have to look for entries further down, which obviously isn't always ideal. So you may not get an entry. That's okay, you don't have to enter every move, remember, but just sometimes you will miss the move, right, from the level that you may want to get into if you wait for this extra confluence. So that's just something that, again, right, you're going to have to just get this with time and what you are comfortable with. So yeah, that pretty much wraps it up in terms of kind of the flip zones. This is obviously what we've been looking at so far, just a very clear structural zone. We're just looking at where supply and demand led to a break of structure to try and validate the zone. This is the exact same thing, except we look for the battle between supply and demand first, right? The major key here is to see that reaction. We want to see demand try to do its job, but then supply step in, cause a reaction to fail and the change of character, and then we look to get short when price comes back into there. Same for demand. Here, we're only looking for the reaction to fail. So what that means in reality, right, is the minute that price is below that dotted line, below where the reaction initiated, right, you can then draw your supply zone on, right, this box here, right, and you can basically get ready to sell, whether you put your order or you wait for price to come in and you just sell at market. But you're essentially getting short before we have the confirmation that price has taken out that low. So you're running the risk that price could fill up some demand within here, right, lower in the zone, and then it could be enough to actually go. That's why it is riskier, okay? So now what we're going to do is we're just going to apply these flip zones just to that price action model that you guys should be very, very familiar with now. We'll quickly go over this, and then then we'll hop onto the charts in the next lesson, and we'll do a full walkthrough just to see how the theory actually applies in reality. So what do we have here? Well, let's just go through this. So we have the 4-hour chart with this thick line, clearly bullish, right? So we are making a series of higher highs and higher lows. So we come up into this old supply zone, right, from previous price action. Price then fills up that supply, and it's enough to initiate a pullback. So we get a swing pullback, and then price forms a higher low, and it moves to the upside, and we get that break of structure, right? We get price forming a higher high. So what did we look at before? Because price cause that high high and cause that break of structure, that gives us that structural area of demand, right? So that's just standard, and that is what this is. But the slight difference here is that we understand that it's also a supply to demand flip, which increases the probability even more, because not only did it cause a break of structure, what did it do? It took out supply. And this supply is valid because you can see the reaction, right? It tried to do its job, it tried to form a lower low, but what happened? Demand stepped in and caused price to fail because it didn't let supply do its job. Remember, A supply zone's job is to try and form a lower low. So if demand steps in before it can do that and causes a higher high, then we have both a break of structure and we have a failed reaction. We have supply flipping to demand is in control, and that increases the probability of this zone. So this zone is a flip and a chock, right? So price continues its next swing leg, it has a bit of a minor pullback and it goes up higher, and then we come into another 4-hour zone, right? So this could be a flip zone. It doesn't matter too much, but price is in here. So now what do we expect? Well, we expect there's a possibility that we could now get a 4-hour pullback, right? Into the discount of this zone, and potentially to come down and mitigate that extreme demand zone, that extreme flip zone. So what can we do to increase the probability that this pullback is starting and that we're not going to get potentially short in a full signal, because price could easily just pull back, right? And it could keep going up higher. Well, we can wait for a 4-hour change of character to take out that 4-hour minor low, right? What is that 4-hour change of character? Most likely, right, it's not guaranteed, but most likely going to be on a lower time frame. Say the M15, that 4-hour minor low is most likely going to be a M15 swing low, right? So when price then gives us that 4-hour change of character, that is most likely going to be an M15 break of swing structure to the downside. So we get a 4-hour change of character, which is most likely going to be now the 15-minute, right? The blue line being in a bearish trend, right? And that is when that gives us a lot of confirmation when this happens that potentially now the M15 is bearish to initiate that 4-hour pullback, right? So that's not a full signal and that we don't go on to make higher highs. Now, what else can we use to increase the probability of this pullback occurring and for where we could potentially look to short? Well, we can look for M15 supply that comes into the market. So before we just looked at where did that supply cause that break of the swing low, right? Then we get that structural supply zone, and that is where we look to get short. How can we increase that probability even more? Well, now we understand what flip zones are, right? So in this 4-hour leg up here, we had this 4-hour minor pullback to then move to continue the swing leg, right, up into that supply zone. It's very likely that that minor 4-hour pullback, if we were to jump down onto a 15-minute time frame, was a M15 demand zone, right? That caused an M15 higher high. So when then price pulls back into that demand zone, we want to look for, was there a reaction? Did demand try to do its job? Did it try to form a higher high, right? As long as it doesn't take out that high and it fails to make a higher high, and then price comes down, the moment it breaks below that low there, where the reaction initiated from, right? So we go below the dotted line, we get that failed reaction. We now know that it's likely supply is in control and this demand zone is failing. But if we also get the change of character at the same time, now we have a flip and a chock, right? So that's now our A+ setup. So then we can look for price to come back into the supply zone that not only caused a structural low to break, but also caused significant demand to fail. We now have that chock and that flip, that demand to supply flip, right? And now this is a high probability M15 zone to play the M15 bearish trend short, to play that 4-hour pullback, right? And that is, how we can validate those zones even more to play that and increase the probability that this will go and that it's not a full signal and we're not going to get stopped out if price was to continue higher, okay? So hopefully that makes sense. Then obviously price then has a deeper 4-hour pullback into the discount of the leg, down in towards our 4-hour flip zone, because remember this demand did what? It took out this supply zone, right? It had the reaction and then demand stepped in to take out that reaction and cause that break of structure. So now we know this is an extremely strong 4-hour zone, so we could get long here, but maybe, we're not sure and we want to wait for a little bit more confirmation that the 4-hour higher low is in place. So what can we wait for? Well, before what we looked at is purely just a market structure break. So we wanted to see the M15 make that first higher high, right, after a series of lower highs. So we wanted to see that change of character, right, which is then what we get over here. What also can we then increase our probability that that 4-hour high low is in place and the M15 is switching bullish? Well, we would look for that demand zone to be created, right? And we would look for the demand that led to that change of character, that led to that break of structure, that led to that higher high, right? And that would give us a strong demand zone. Now, also, do we know, right, that can increase the probability of that being a strong zone? Well, we look for one that also took out supply. So how do we know that it took out a significant supply zone? Well, we need to see that reaction first, right? We need to see that battle, and that is really key. So when price pulls back up into this supply zone, right, this M15 should be a strong supply zone because it caused the break of this low, right, to form that lower low. So now we have a structural supply zone right here. Price comes into that supply zone. It tries to do its job. It tries to make a lower low, but it fails to take out that low, right? It fails to do its job. And then demand steps in to not only cause the reaction to fail, because remember, the minute we are above the reaction, right, we don't need a change of character. We just need to go break above where that reaction initiated from. As soon as we're above it, above that dotted line, we now know it's very likely that that supply is going to fail. It's not confirmed until we break above the zone, but we know once the reaction goes, it's very likely that it will fail, right? And then if we also get a change of character, then we know this is a very strong demand zone because it took out strong supply and it took out structure. It caused that break of structure to the upside. So now we have a flip and a chock with this zone, and that is a very high probability zone. So what we can do is wait for the M15 to pull back to get an M15 high low, and we could just buy straight away there on the M15 zone, and that is more than valid. But maybe we want to wait for a little bit more, even more confirmation or even more refinement. So we can drop down to a lower time frame to confirm that this zone is going to hold and we are going to get an M15 high low in this area. So let's say we jump down to the M1 time frame. Right, exact same thing. I'm not going to be as pedantic this time. I'm just going to explain this one quickly, right? We obviously have supply making lower lows and lower highs. It must have created supply to take out that low. So then the price pulls back up into supply. If that bearish trend is to continue, what should happen? It should form a lower low. Price then fails to do so. Demand steps in and it takes out the reaction, right? So we get the failed reaction, but we also get the change of character. So not only has price taken out a strong supply, but it has also taken out structure to form a higher high. So now what we have done is validated a very strong M1 demand zone for us to then buy, right, from this area, which has confirmed the M15 high low. And that M15 high low did what? It confirmed potentially we have the 4-hour high low. So then when we buy in this area, we have an extremely strong high probability swing trade, right, with lower time frame precision to now target this weak 4-hour high because it failed to do its job, right? Now, let's say that price does actually go on to make that higher high. You have to think about that whole cycle has now restarted because what has happened from this area of supply here? Well, it's tried to do its job, right? It initiated that pullback, but its job isn't just to start a pullback. Supply wants to try and create a lower low, right? But for it to do that, that supply zone needs to lead to a break of structure of this low here, right? This supply zone up here needs to try and take out this low. But all that's happened is it's pulled back, right? And then price has gone on and it's taken out that reaction, right? To cause not only a break of structure, but also a failed reaction of this supply zone here. So then what would happen when we would look later on is somewhere around here, we would try and identify where that 4-hour zone was, right? That led to that break of structure, that led to that zone being taken out. And then we can do the exact same process over and over again, right? Dropping down through the time frames, looking for that flip zone, right? Takes out supply here, reacts, change of character, demand flip, right? Draw on the demand, price comes in and we get long, target the high, so on. And yeah, so forth. So that wraps up the theory. Hopefully it's starting to make a little bit of sense. Watch this as many times as you need to. Recreate these diagrams as well is something I'd always highly recommend. That goes for all of the ones that we've looked at so far on the course. I've obviously provided the screenshots of these annotations below each video, but I would really recommend doing the exercise of making your own ones, drawing them out, because just the process of doing it will really kind of help to just to put it deep in your subconscious and help you identify where there may be any subtle gaps in your knowledge thus far. But anyway, I'll leave that there. In the next video, we're going to hop on the charts and obviously take a look at how this plays in reality, because of course we're not always going to get these nice, perfect utopian examples where price moves really slowly and we don't get any full signals, right? Of course, it's going to be a little bit trickier in the live market, but yeah, let's take our time on the markets and we'll give it a go and see if we can identify those. But what I will actually say, just before ending this, is if you guys feel a bit confident, is have a quick go on the charts now, whatever currency pair you've been using thus far with all of the exercises to draw on your zones. Obviously you should now have your structural zones drawn on. Just go over and have a play and see if you can identify where these flips are happening. So look at old supply zones and then look at where demand took them out and see how they react. Does it make those demand zones hold even stronger? And obviously look at where demand takes out supply. Sorry, where supply takes out demand. And so on and so forth. Because then when I go back through them on Eurodollar, it will just make the exercise even more useful if you do it before I go through, and then you can see how my thought process is as we go through it together. But yeah, I'll leave that there. Have a go with it and see how you get on. All right.